Hi, and welcome back to the European VC, the go-to podcast for everything European VC. If you love the show, share it with your friends and join our newsletter at eu.vc. Today, we're happy to welcome Patrick, co-founder of Form Ventures, an early-stage VC focused on investing in startups that are disrupting regulated markets or building in new markets that will face regulation. Patrick helps founders break down policy barriers and shape winning regulatory strategies. If you enjoy our content, do support us by hitting the follow button, giving us a review, and following the European VC on LinkedIn.
Patrick, welcome to the European VC podcast. Super nice to have you here today. How's everything?
Great, thanks. Yeah, just the last sprint before Christmas. All good.
Yeah, looking forward to that. Christmas is one of my favorite times in the year, so I'm very much excited. Thank you for reminding me of that. I appreciate it.
How's it going?
Andreas hates it because he had no love when he was a kid, so it hurts.
Yeah, I'm like the Grinch. It's the same problem. I told my wife last night that all I wish for Christmas is that I get to drill a hole in up to the attic that I can then take pull a wire from my internet out into my my office. That's all I want for Christmas. Then I'm happy.
And on that note, Patrick, we've known you for some time now, actually. So that's really cool to have you on the pod. But to our listeners who have no idea who Patrick is, Form Ventures, they don't know what that is. Give us a quick rundown. How did this all come to be?
So, well, thanks for having me on for starters. Just for those who don't know, we're a pre-seed and seed fund focusing on, we say, the future of regulated markets. So that's either traditional regulated markets, fintech, health tech, utilities, or what we think of as the next regulated markets, so new markets that haven't been fully regulated yet. So very obvious one there is crypto, but also cultivated meats, carbon offsets. We'd put medicinal cannabis in that space. But between those two, that's what we think of as the future of regulated markets, and that's where we focus. In terms of how we started, I guess it's long time ago, back in 2010. Leo, my co-founder, and I were both lobbyists. We worked for the biggest lobby group in the UK, the CBI, and we did that for 3 years, focusing on different kind of policy and regulatory areas. And then years later, 2018, I was leading a corporate venture fund for Deloitte and doing a piece of work on, okay, how do we kind of make money as a corporate venture fund? And I remember seeing for the first time that depressing statistic. I think it was Mark Andreessen's statistic that 15 companies a year in the US return 95% of venture returns. So the big question for us was like, okay, how do we get allocation in those companies? What can we do to justify our seat at the table? Because I just thought, if we can't answer that question, then what's the point in working in venture? So Leo and I got to thinking, like, okay, would a fund that focuses on either these new sectors that aren't yet regulated or traditional regulated markets, and use the fact that we had lots of experience in dealing with all the opportunities and risks that come with moving in a regulated market, and offered that to founders. Like, would that be sufficiently differentiated to be able to win allocation in those companies? And so we spent 6 months testing the market, and obviously we thought we were the first ones to come up with this genius idea before we realized Tusk in the US were doing it. So that winter we went and saw them, and they said, oh no, we have no interest in doing Europe, which was obviously great for us. So that's when we started raising the first fund.
When was that, for our listeners?
So that's winter 2018.
And in terms of development, where you guys are today, still running Fund 1, already with Fund 2, just so everyone has a common understanding before we deep dive.
So the first thing we did was scrap together $1 million to basically prove we could do it with a pilot fund, so 10, 100K checks. And that was really painful. That took about 9 months of asking literally everyone we'd ever met for money, which was both embarrassing and hard work. But we got there, and we started to deploy that. All the while we were having conversations about like the full Fund 2, because we still had day jobs, right? We can take any fee from that $1 million, or if we could, we wouldn't have been able to survive on it. So we were pretty much continuously fundraising for the bigger fund 2, which we closed last September, so September 2021. That was like a full 3 years, at least 3 years from when we started talking about it. And that's a 30 million fund. We now have 4 people investing at pre-seed and seed. So we could take a salary from last September, but before that, we basically couldn't. We didn't make any money for over 3 years,
which was great.
Yeah, I mean, I should say I had another job for 2 of those years. It was just only 1 year when we took no money, and it was really painful. But then, we believe we'd get it done, and fortunately, and there was definitely a lot of good fortune, we did get it over the line.
It's too cool. It's too cool. I would love, because back when we spoke the first time, Patrick, when you said you'd done a €1 million first or dollar first fund, I think I said, I'd love to dive deeper on that, because most times you hear people doing a POC fund with 5 million in that neighborhood, but you went for 1. Could you tell us a bit about the thought process as to why did you do that, but also some of the learnings afterwards, and would you do it again?
Yeah, great questions. The first one is, I mean, we would have loved to have done 5 million if we could have got 5 million. So probably don't have wealthy enough friends and network. That's one issue.
Always a problem.
We basically, the way we saw it was, we have to prove to LPs that we can do each stage of the value chain, from like seeing the best deals, deciding, winning the best deals, adding value, or like exit. Okay, that's unlikely that we can prove that early. So what is the like MVP for that? And we thought like 100K tickets. Obviously, that's not what we're trying to invest in the second fund, so we can't prove that we're going to get 500K's worth of allocation, which is like the average ticket size in fund 2. But we can prove most of the other things. Like we can get founders to say, yeah, these guys are really differentiated. We made room for them on the cap table. We can be present in the market. We can show that we're seeing the best deal. So I guess we thought 1 million was, and it was probably it was the very, very lowest we could do. And I think actually one of the pieces of feedback we've given a couple of LPs is that in the UK, and I think you guys have talked about this before, that there's a gap for those like properly emerging manager funds between, like, a lot of people can scrap together 1 million, but jumping from 1 to 30 was like, we were lucky to do that. And in the US, I think that's less common. Like usually people would ladder up like 1, 5, 20, 40, like, and it would be kind of more, there'd be more steps in between. And so the honest answer is we would have loved to have got to 5, but like 1 was.
I'd love to ask Patrick, did you race on the back of an angel track record or none?
Only the investing I've been doing at Deloitte, which was low cadence, and anyone who's been near CVC would know, like, it's hard to pin down what you're actually responsible for. Like, and I completely, when LPs highlighted that, I've had to hold my hands up and say, like, yeah, it's true. I ran the team, I ran the processes, I sat on the investment committee, but it's not like, it's not like your own track record. So basically we were really looking for true believers. And I think it only worked because of how highly differentiated we were. So we could go to people who had experience in tech policy, or ex-regulators, or founders in markets where they run into these issues. And for those people, it's like, oh, this should definitely exist. But I really would not have liked to have been like going to them with a generalist strategy. It just wouldn't have worked.
But then, Patrick, tell me, why the hell did you opt for doing a fund 1 of 1 million rather than, I've got this deal, let's do a syndicate, and then 2 months later, I've got this deal, let's do a syndicate?
Yeah, so this is so interesting. We would have done that, but almost the first person we talked to, and we weren't even pitching. There was someone my partner had worked with who is another fund manager, and he basically backed us with 250K without us really pitching. We're like, shit, we should just run this as a small fund. At the time, AngelList still had their what they subsequently have closed down. They still had their fund manager like infrastructure. So we just thought we should just do this as a mini fund. It's like another piece of evidence we can show LPs that we are kind of playing at manage. Exactly.
Yeah. That was the worst favor anyone could do to you. Here's 250. Don't make a fund, man.
I know. And this is funny. Your final question, I guess, was like, would we do it again? We often say, like, if we had known how hard it would be to get to the 30 million fund, like looking back, would we have thought this was the best way to build Form? Like, maybe not. Maybe it would have been better to go to kind of bigger funds for a couple of years and then try to come out with like more of a track record. It's just really, really hard. And certainly in this fundraising environment, we thank God that we closed autumn last year and weren't in 2022.
That's exciting.
I'd love to kind of focus the conversation on, the reasoning behind you guys investing in what you're investing. So why the hell, raise a fund to invest in the future of regulated markets? And from where I'm standing, it's quite obvious that a lot of it is due to your background. And that is, it goes almost without saying, I would say, right? But maybe the what isn't as obvious, at least to me, is what is actually the opportunity? How do you see the opportunity to invest in this space? And also connected to that, how that informs, as an example, the type of business models you're looking for, or is it software play versus hardware play? So how that informs all of the spectrum of deals that you're hunting for now today.
Yeah, it's interesting. Yeah, it's interesting. While we sound highly differentiated, we tried to remain like what we called vanilla in pretty much every possible way. When we were pitching LPs, we said we just knew that LPs would naturally be reasonably conservative, and so while we're innovating, like we wanted to be kind of straight down the line in pretty much every way, except for how we're differentiated. So what that means is we're doing pure software. We're not going into bio, and we're not going into hardware. We're like very kind of conventional. We're looking for like you were unicorn hunting. So in many ways, we're just a straight down the line VC. In terms of the types of companies we look for, that why we're after these like regulated or newly regulated markets, really two reasons. One is we just think Europe has an edge in these markets. And I was listening to the founder of Plaid talk about this and him saying like regulated companies aren't necessarily best built in Silicon Valley. Like what Europe has is regulators that tend to be more collaborative. They like this. There's basically we seem to have a recipe for good regulated businesses in Europe, and in the UK specifically, we were looking at the unicorns, and I think there are lots of obviously different lists, but it seemed to us that about like 2/3 or more of the companies being built were in what we called regulated markets. Obviously, a lot of them are in fintech, but also health tech, energy, increasingly bio. And so we rather than saying like we think the future is going to be that different to the present, we just thought that if we are unicorn hunting, let's see where the unicorns are and pitch to LPs like we think we can get allocations in the most interesting companies. The future is likely to be as it has been in the past, which is we're particularly good at regulated markets in Europe. And then, so that's one side of why we thought these companies, why this is the strategy. And the second is, as you say, it's just tied to our backgrounds. Like we are used to helping companies like these basically get through, overcome policy and regulatory hurdles. I was doing it, but before I was briefly a strategy consultant in regulated markets, and obviously I'd been a lobbyist. Leo had been, after he had worked at the CBI with me, he became a regulatory strategist, often working for VCs when their companies ran into regulatory issues. So he was working as an advisor to VCs, like usually when things went badly wrong, which was way too late to deal with them. As you probably know, like once you piss off a regulator, like it's probably too late to like turn things around, or it's much harder to. Whereas if you're proactive and you take these things seriously early, which are most often the founders do, then you've got a really good chance of scaling.
I have a question, which is, it's one thing that you've got a great differentiated value at, which means that the founders want you. Okay, check. But if you are, an investor that knows a lot about regulation, but what the hell brings fintech, health tech, energy, all those verticals together, how do you pick? Because, okay, you've got a huge regulatory problem. Let me invest. That's probably not the thing you go for.
Yeah. So that's a great question, and also something that several LPs raised with us, and our answer was always the same, which is we are first and foremost just a VC. So differentiation is a means to an end. We are a VC trying to be top decile fund in several consecutive funds. So the strategy is a means of doing that. When we go to invest in a company, what we're not trying to filter for is companies that have the biggest regulatory issues, because as you say, like we will just be running into brick walls all the time. Like we think we have a strategy to get into many of the most interesting companies that are being built. And that's what we're trying to serve. So, we joke sometimes saying like, well, you could argue every company is regulated, and that's kind of deliberately the case. Like, we want to be able to try to get access to as a broader kind of top of funnel as possible. There's obviously limits to that. Like, we probably wouldn't try to convince Calendly when they were, I know they didn't take money, but like, that type of pure B2B SaaS, like, unlikely to be something we can go for.
But then, how do you deal source? Because, the typical model for someone with that type of specialty, when it's not, tied to a vertical as such, but it's more tied to a very special value add, is that you're invited in to all the best deals because, they need you. So for that reason, Bessemer knows, Index knows, whatever, that Patrick is the guy we need to call to. We only have to give them a small slot in the cap table, and then we're set for everything regulatory. Is that often how deals come to you, or how do you source?
Yeah, so that's always been the aim, is to be that player that like, we we don't intend to lead rounds. Like, we have co-led a round this year, but by and large, we aim to be the second or third biggest ticket on the cap table at a given round. So yeah, we want to be the fund known for when you have some form of policy or regulatory exposure, we should be on the cap table and leads should seek us out. I mean, that's not always the case. We're trying to build a brand of our own. Like, we would love founders to approach us directly, and they do. Like, increasingly, we do have a nascent brand, but yeah, exactly. We would love to just be basically, we want, for two reasons. One, because we want to be able to get into the best companies, and often the big brands are the ones seeing the best deals. But also, we don't want to play the game that lots of leads are having to play, which is like, at the point of committing to a company, you might only have a 50% chance of winning that deal. Like, we would ideally have no churn at that rate. So far, fortunately, with both the Fund 1 and Fund 2, which is now 17 deals between the two, we've never committed to a company and not got the allocation that we need. So we see, like, if you compare that to everyone having to compete for lead positions, I'm sure people obviously don't want to report how often they get churn at that point, but presumably people are getting lots of churn because everyone's, for competitive deals, lots of people want to lead.
Of course. I'm curious about on the LP side, both for Fund 1 and Fund 2, obviously, but Fund 2 being more interesting. Do you have like lobbyists, public affairs professionals, and firms kind of in your LP base? How do you think about that? And what are the lines that are at play there of the relationships that you have with those individuals, if you have them in your LP base? And what do you do, and what is a no-go kind of red area, red zone? Don't touch, don't do that.
Yeah, interesting. So public affairs, lobbying, that area, I guess one thing to say about that upfront is that lobbying in Europe is nothing like it is in the States. So the kind of what you see in like films of people paid off or smashing down doors or things like, it just does not happen in Europe. It's far more collaborative, much more about positive engagement, like engaging in consultations, being proactive, that type of thing. We call it, like, some people call it lobbying. We tend to avoid the word just to avoid that like US kind of sense of what that looks like. In terms of LPs, though, they don't tend to be that well paid in Europe versus the US. So lobbyists, public affairs people, like we have a few as LPs, but they are certainly not like the main constituent parts. It tends to be people, like the legal profession or professional services. So that's on the high net worth side, or just fund managers, basically, who have invested in regulated industries before. And then obviously given that Fund 2, the 30 million fund, is our first institutional fund, we did pretty well on like the kind of institutional / semi-institutional layer. So we have 3 of the emerging manager, like European backers, who you guys have talked about in the at length before. So definitely ones that you know. And it took a long time to get them in, justifiably so. But we're absolutely delighted to get them in, because we always wanted to be like, this is about building something over 20 or 30 years, getting professional backers who can hopefully back us for that time period. And we were just wary that if we get lots of individuals in 3 years' time, we're going to have the same painful process if we have to seek out another set of new LPs.
I actually just earlier today had a conversation with an emerging manager about, why he wanted fund of funds on his cap table and so on. Could you dive a bit into, where fund of funds have really made a difference to you, and how you thought about when to engage them, how to use them, both during the fundraise but also after?
Yeah, so this it's a great question, and so in advance of closing, we used them. Well, one, the actual pitching itself really helped us hone our pitch because they are, you do get obviously professional individuals investing in funds, but the level of professionalism among the fund of funds is just really high, and so as a test of your pitch, it's just brilliant for just improving. Then you've got introductions to others. I say, obviously, if they're considering you and they're potentially keen on investing in you, then you get introductions to others, which was great. Once we had them on side, it really felt like this is definitely going to happen, because these the stamp of approval which we had was just really high, and then it helps you actually bring in others that you might already be speaking to, and then so that's before the investment, and then afterwards, just the degree to which they care about business building, I think, has been brilliant, because we love we love venture, but also love building a fund as a business, and fund of funds really buy into that, which is great, because then you can talk about team building and what's your structure look like, and how you incentivize people, all the questions that we VCs will talk about for startups a lot, but actually at the VC layer, there isn't, and also VCs can be supportive of each other, but there isn't, even in London, the community is still nascent compared to what it is on the West Coast. So having the fund of funds community in support of that has just been brilliant. So it's been really, it's been great.
I'm kind of resisting the urge since this started to ask a completely unrelated question. As the regulatory guy that really understands venture and regulations and stuff, I have to ask you this question, which is, with everything that's been going on in crypto land, where do you stand? Share with us some of your educated and enlightened thinking.
So where we stand is we, as the investor in the future regulated markets, we have not made a single investment in crypto. And that is not because we are super bearish on the sector. It's for two reasons, really. One is our view is for the very best deal flow is going to insiders, and we are still a generalist fund. If we are collecting stuff that's coming out of those communities, it's probably a negative selection bias, and that has made us really, really wary. So until basically we take the time to really, really commit and go deep to join, get embedded in those communities, basically, which obviously Andreessen have done that. They've got the biggest crypto policy team in the world, more so, I think, than any other government. So they've chosen to do that, and they've made regulation the most important thing. So we've always known this is somewhere we should go at some point. We just haven't done it yet, got to that level. And the second thing is we're frankly wary of brand risk. If we're the guys who are meant to know about regulation, both opportunity and risk, and then we start making bets that blow up, it's these guys got it wrong, and they're meant to be the experts in this space. This is a serious brand risk for us. So it's basically a decision point that we have to reach, which is when are we going to go deep to get. So the most important thing for us is taking the decision to go deep so that we can get into those deal flow communities, so that we can be confident we're seeing the best deals. And I know, as you guys, I'm sure, do the crypto funds in Europe. In fact, one of the guys, Alex Shelkovnikov out Semantic, who's a great guy, hired me back in 2016. When I speak to him, I'm reminded oh, this is where the communities are. They're not where you are. They're somewhere else. So, so when you have at least access to that conversation, I think is a good warning to be careful.
I have a question, which is, when your value add is on the regulatory side, does that mean that you also, do you like regulatory risk? Meaning of obviously you'd prefer there not to being, but is that where you kind of differentiate in your selection, that you can take a bet on places where there is regulatory risk, and you can then kind of chart out the path, or is it more that?
Yeah,
tell me.
No, yeah, sorry. That's I guess that is one way to frame it. I think when we initially pitch the fund, we often focus on the value it plays in the value chain, in the portfolio value add part of the value chain and less on the decision making. But the reality is we do think that our knowledge of the regulatory and political landscape gives us a bit of an edge in decision making as well to like properly price regulatory risk. So that might be, a VC looking at some type of retail investment app which involves leverage or crypto or something that basically we know, like, oh, actually, we know the FCA's view very well, and we think it's being like mispriced either on the upside or downside. So there are times when we feel like we can gauge that better than most other funds. I would say we tend to stay away from like binary risk. Yeah. I think people see us as potentially as the fund that's willing to take the binary regulatory risk because we know the space, but actually anything that is that close to just being killed, we think no, better to stay away from it because we can't tell the future. Yeah. There could be a change of government that just closes certain things down. If that's the case, we don't want to be investing in that area. So I'd say it's not always the case that we have an edge in that space, but we do find ourselves sometimes looking at deals where we think, oh, the risk is being like priced wrong here, either on the upside or downside.
Could you, and I don't know if you can give an example, but if you could, it would be awesome. If you can't, that's fine. But could you kind of detail a bit more on that value add side? So how is your relationship with the startups, and how are you providing, that value within your expertise? And as an example, I remember that before I was even in venture, I worked for a startup in the electrical mobility space, and they faced so many challenges when entering Europe, right? Many of them US players, but they were also at a later stage, right? So I was kind of thinking of that, and I thought, but that was actually when they were expanding across you. So I'd love to understand a bit more in detail, how your interaction with the startups is.
Yeah, I mean, the electrical mobility space, I mean, unfortunately, some of the big players, their share price now looks terrible. But at the time, we said like, they would have been perfect examples for us and actually Tusk in the States was an early backer of Bird, so they were often a use case we would highlight. So we can talk like pretty openly about some of the work we've been doing. I mean, the type of thing we would focus on is if you're taking on an international market like cultivated meats, one of the things you have to think about is like geographical expansion, like which markets you're going to prioritize. Some of the biggest, arguably the biggest factor in determining that, alongside say market size and consumer behavior, is the regulatory treatment of cultivated meats and how quickly can you get to market. So that's something that we would like talk to the portfolio about. So certainly international expansion is a conversation we have with our portfolio. That's obviously often not a seed stage conversation, but like if you're, once you get to say Series A, especially in a market like that where you have to be quite selective of markets, it's quite early. Another one, so we're just making an investment in in a market that uses gig workers, and that's a market where the legal treatment of gig workers is still, we think, hasn't really reached a stable point, and like different market. I guess we've been saying this, that like 5 years ago, we might have thought that countries would converge and everyone would end up treating them the same way, but this really doesn't seem to be happening. Spain is moving off in one direction. The US and the Democrats seem to be moving in a slightly different direction. And so a platform basically that is using or is serving that market is just understanding how they should see that risk kind of potentially unwinding over the next few years, and what they can do, partially at the product layer, but partially just in terms of how they represent themselves in the market, how they potentially represent themselves to government. That's a really early conversation to be having, and they're still a very early stage company.
Yeah, but it's interesting that you're bringing that to the table that early. That's cool. On that note, how I guess that you guys as an emerging team as well, you've put a lot of work and effort and at least thinking time into how to position yourselves towards founders so that they see that you guys have relevance, that have a role to play, that are important. Building up your brand. Many might not know your brand, right, when you first approach them. I'd love to ask you about how has been that process internally, and also some learnings you have that could also be kind of translated as relevant to other emerging GPs listening in?
So on the brand building side in particular, it's been really interesting. I think when we started, because we spent a long time, as you say, thinking about strategy, like how can we optimize every stage of this value chain to make sure we get as good a shot as any fund of being a like top decile fund. The stage that we thought, okay, this is going to be our weakest is brand and deal flow. Like, how do we make sure we see every deal? Because, we say, like, if we miss a single deal that's in our space, that could be the golden ticket, right? That could be the company that would be the fund returner, and then you don't have a fund in 5-10 years time because you just missed out on that company. So that is where we need to be. We feel like we've got the most headroom to be building. And I think, when we were doing all our strategizing with a whiteboard back in 2018, we kind of hoped that if we just got to the perfect strategy, then deal flow would just like look after itself. And that is obviously incredibly naive. Like, you just need to, where we landed was, no, we need to, it's not enough to give like a co-investor a rational reason to bring us in. We need to be working harder than anyone else, like be at every single event, be like spend loads of face time with co-investors, like basically do what other investors or generalist investors will do as their basically their whole strategy. We need to be doing that as table stakes. We need to be at every event. We need to like this. So we do, and that's Maya, who we hired on the team. I credit to her. She spends so many evenings a week at events, and Leo and I both have kids under 5 kids under 5 between us. So we try to get as many as possible, but it can get pretty brutal. So yeah, it's basically, I know that's more of a tactical point than a strategic one, but I think we've basically landed at the view that you can't really substitute for that, like just ground game and deal flow, making sure that you are around and in people's faces at all times, and just generally, like, we have this like being friendly as a differentiator in the venture market. I still think that's slightly a thing. Like, there's a lot of people who aren't particularly friendly, and therefore I don't think they get the call. So.
Yeah, being friendly and the do no harm. I love that.
Yeah.
Don't be a value sucker. Yeah, do nothing. Andreas, anything you'd like to deep dive before I take us away?
It's almost a question that we have in the quickfire, but I would love, Patrick, just because I think, judging from all this, the CSI and I don't know what crime series that exist. I think most people do like regulatory stuff and kind of stuff that's borderline illegal and that kind of thing. So tell me, could you not pull out one example of something, a space that you think is either incredibly exciting, but it's a super edge case that, it's funny to dabble in, or you've just seen something you've seen founders working where you think, that's an interesting take on the world.
Yeah, interesting. I mean, there was a fund in the States called Vice Ventures that, like, I don't know if you know them, but they explicitly focus on the Vice clause, which other VCs can't invest in. And I do think it's a really interesting set of areas. We have stayed away from edge cases until this point. I guess one of the areas that we've just looked at quite recently that we don't see much of in the UK, but we're really excited by is like nuclear, like very heavy, and so kind of heavier, hard to do sectors that we're seeing more of in the States. Just feels like there is, when you see a really, really good team, like taking on something like that, it gets us really excited. So that's not an edge. It's more of an edge case in terms of how many teams are there that are really, really good in that space, as opposed to something that's on the edge of legality. Trying to see, I mean, the thing I mentioned, medicinal cannabis, and like psilocybin is obviously an area that's getting a lot of money in the US, Canada. It's one of those things that we would love to be looking at closely, but the reality is we're a UK fund, and UK politically in this space is just, we are not going to be leading the way even in Europe. So as a general kind of headwind, it's something that we often mention, and then we have to say, yeah, but we're very unlikely to make any investments in this space.
That's actually a very interesting point. To what extent do you factor that in? The legal framework of the country from which the startup originates, right? Because also that is, I'm guessing more about the legal pathway or regulatory pathway in Britain than in maybe Spain or Denmark or so? How do you navigate that?
Yeah, so that's it comes back to what you were saying earlier, that we're doing regulation as a horizontal, but like what's healthcare got to do with financial services? What's that got to do with cultivated meat? And then you map onto that different countries, and that is a hell of a lot of work. So what we often say if a founder raises that is, we've taken something reasonably narrow in terms of regulation and policy versus every other part of the operating stack, the most VC, hiring, strategy, product. So we've taken something reasonably narrow, but by taking something reasonably narrow, we commit to doing the work. So if you happen to be a company that says, well, like digital therapeutics, which Germany is seen as leading the way, and like I didn't know anything about that a year ago, but now I have to read about it like on a semi-daily basis because it's what the portfolio expects. And so that's what we as a team have taken on. I think as the portfolio expands, we're going to have a question about like, oh, you've got 50 companies, between 50 companies are alive between funds, and they all have slightly different policy and regulatory issues. And for me, that's why like there's only a degree to which there's economies of scale there. We will have to increase headcount to manage that, because we've always just said we will never compromise on the value add, because ultimately founder brand is like what we want to prioritize for.
Do you think about building network? Because I was just about to say before, we should do a syndicate with you guys, and we should get all the lawyers, one lawyer in each country, or 5 lawyers in each country. How do you think about that, building the network around you that allows you to deliver that value at a scale?
You must have been listening into one of our sessions on scaling, because one of the things we've discussed is like, look, this would work. We're doing it in the UK, it would work across Europe, but I'm not going to try and do like domestic French healthcare policy from London. How do we scale that? And that network thing, I think, is one potential model that could work well. And as you say, either a network, well, probably a network on the co-investor side, but network on the LP side is probably the most interesting way to do it, where they are incentivized. You get ex-regulators or lawyers in those markets who can help at a certain level, and then you have a team kind of sitting above them. I think that's a really interesting model, and it's genuinely is for us. It would be about tapping into those networks. How do we get to them as LPs? And I know that's what you guys do really well, is helping that like distribution, basically, because I don't know lawyers in Central Europe.
No, exactly. Interesting, super cool. David, now you can take it away.
Thank you. Patrick, we always love to end the episodes with a quick fire round. That's when we ask quick answer questions, 30 to 60 seconds each. Are you ready?
Shoot.
Which areas, technologies, or sectors excite you the most that you find other people around you not really that excited about?
So I'd have to say the hard to tackle markets. And so I'd put energy in that space. Cultivated meat, because still, I mean, it's a growing trend, but globally, there are still not that many companies taking it on. Basically, hard to tackle problems where often there are slow-moving incumbents, like oligopolies, complexities about how the private sector is working with the public sector. Because there's certain risks in those markets, both VCs and founding teams often stay away from them. And it means when you see a really, really good team come forward taking it on, it's just you want to be in that company, because you think if anyone is going to disrupt the market, it's only going to be one of like a certain number of teams. And if you find one of the best teams taking it on, then it always gets me excited.
Second question of the quickfire is, what are your top tips for emerging VCs who are now fundraising?
I guess my first tip would be, because the market is, we found it very tough 2018 to 2021, and the market has got harder, or like fundraising, I'm sure, is harder now. My first tip would be just being very, like thinking through strategy at length before you dive in, just because there are lots of funds fundraising and you want to set the bar. Like it's really hard to convince good LPs to back you, at least in a way that will give you like a career as opposed to one fund. Like you might be able to get the first fund together, but if you're doing this as a career, you want to have a strategy that is going to stand the test of time, and testing that with existing VCs. Like emerging managers like us will always make time to speak to people who are thinking about launching their own fund. So test it with people in the market, founders as your customers, LPs if you can, existing VCs, to make sure that it basically that strategy has the legs. And then on the LP side, we got to the stage where, well, one is managing your LP pipeline like a sales pipeline. Like never be too ashamed to just hammer people with emails, because what is incredibly important to you is only a tiny fraction of that LP's time. And that asymmetry is what can drive you a bit mad, because you're waiting on an email. But like, that LP might not have thought about you for a month, and that's fine, because you're only a tiny bit of their day. So just kind of getting over that sense of shame that you might get from hammering people with emails, and just being helpful or reaching out like that. Those reminders, we found sometimes it was the 10th email that got a response from people, and some of them made it into our LP base. So I think just being super proactive in communication, and as I say, managing it like a proper sales pipeline, I think is the way to go.
I love you saying that, because I feel like I've just yesterday done an as big a commitment as any LP has ever done, because of a cold follow-up email from Superhuman, because I'm right now in the process of shifting from Outlook to using Superhuman, and going through the awful process of shifting away from the email system I've used for a decade to something else is really grueling. But it was on the back of them sending, "Hey, you once signed up for Superhuman. Do you want to? Now we have it for
Yeah.
and if you really come with something that's valuable, which you should to your LPs anyway, otherwise they don't really matter to you, right? Then you shouldn't be afraid of sending that ping and saying, "Hey man, this is what's going on, blah blah blah." So for that reason, I think that there are probably many managers that are less vehement in running it as a sales process, where you have almost automated follow-up saying, "We haven't spoken for 14 days. I'd love to just touch base. Here's the latest news from us. Hope you're doing good."
Absolutely. You've got to, as you say, you've got to back yourself to be offering, like, you've got to believe that you're offering them something valuable. This isn't you begging for money, right? It's a value exchange. If you really think it's in their interest to get back to you, then continue hitting them.
And if not, well, then you're not a fit anyway, right? Then who did you hurt? No one, really.
Exactly.
Third and final question, Patrick, is probably my favorite as well. Your most counterintuitive learning since you've been in venture?
I guess my most counterintuitive learning is just how much of a people business it is. And maybe I mean, this is a bit of a cliche now, lots of people say it, but it feels like being a really successful VC, one of the main things you can do is just be very, very good at dealing with people, whether that's being good with founders so that founders want to have you on the cap table just on the basis of who you are. That's like people as a brand, and obviously the solo VC movement is testament to that can be enough to make you really successful. Being generally helpful as an existing investor often gets you great references from founders. So all these things were not the things that we were thinking about back in 2018 when we were mapping out the strategy. We were trying to be very, very analytical and work out, okay, how are we going to compete with others, and what's our pitch? What exactly is our pitch? We almost never said, okay, so just how are we going to deal with people at each stage of the value chain? Because we do that really well, then that gives us a great shot at being a really good fund. And I think a lot, especially at pre-seed and seed, there are some of the most interesting emerging managers. When you look at what they're pitching, they're really pitching like, I am the type of person who people want to work with. And I think I buy it. I think it's I would give them my money.
You're absolutely right. It is a differentiating factor to be able to actually stay on top of everything and come back to people in time, and give them due respect at every single interaction. Especially in VC, as a VC, you get hit by tons of emails every day, inbound deal flow that everyone, you want to help them, but you can't. And then too many end up not replying, not out of them being bad people, but simply because they can't figure out exactly how to get the thing set in the right way. So Patrick, thanks so much for joining us today. Thanks so much for, bearing through a 3-year race, 2 years with one employment and 1 year without any salary at all, to now finally be on Fund 2 and out there kicking and swinging. So that's beautiful. Thanks a million, Patrick.
Thanks a lot for having me on. Love the podcast, guys.
Thank you for listening to this episode of the European VC, the go-to podcast for everything European VC. If you love the show, share it with your friends and join our newsletter at eu.vc.